Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I've got two paper money trades for you today to look at, two names that are in the news for different reasons, Tesla and Uber. So you could basically say this is an autonomous driving show today, or a theme for us. Let's get to our first trade of the day, and that is Tesla. Now, Tesla has some news out. Couple things. A Bank of America downgrade to neutral from buy. They also lowered the price target on their target on this name. And then also CATL, not a well-known company. It's out of China, but it's a Tesla supplier. They were put on a blacklist designated as a Chinese military company. So that could also disrupt Tesla. So two news articles on Tesla, not both of them in the negative camp. So Tesla down, I've got about 4.3%. The overall market has now turned negative, so there's another catalyst. So how do we play this? If you're looking for a long-term bullish position in Tesla, that's the assumption that I'm making here. If that's not the thought, you could do the put side of this or something else. But I looked at something that gives myself some duration. So if I go out to January 31st, that gives me a full 24 days until this trade takes place. And what did I do? I looked at something with modest, not crazy, modest upside in Tesla. So I did something we don't do a lot on this show, but we're going to start doing more of them, is the unbalanced butterfly. What do I mean by that? Now, historically, the normal butterfly is a 1x2x1, and we're going to keep that, but the normal butterfly has the strikes equidistant, right? If it's $20 on the first side, it's $20 on the second side. We're going to use a little different, the unbalanced butterfly. You can see it there on the on the chart. Why? A lot of times butterflies are very frustrating for traders because they go up, as you can see on the graph here, and then they come all the way back down if the market moves. In this case, if Tesla were to move violently to the upside or to the upside, this one won't come all the way back down, and here's why. I'm buying a $20 call vertical, the 420, 440 call vertical in the January 31st expiration. Then, to fill out my butterfly, I'm selling the 440, 445 call vertical to reduce the net debit of that butterfly. Buying a $20 spread, as you can see, that's where the peak is, selling a $5 spread. So this spread peaks out at around 440 on the strike. That's where the peak is there. But if you see, if it goes through there, it stays profitable as far up as Tesla goes. So there's the difference between the fundamental butterfly and the unbalanced butterfly. This gives you a little more of a delta. And remember, I've got it up there for about a 580 debit, but now it's trading about 440 debit. So that is the difference there between how this trades. It's a bullish trade. Whatever the debit paid on this trade is the risk on this trade, and it maxes out at, like all butterflies, like all calendar spreads, the short strike is where this maxes out. In this case, $440. So there's our first trade, an unbalanced butterfly in Tesla. Now let's get to our second trade, and that is Uber. Now, Uber had some news out this morning, all in the wake of Nvidia's Jensen Huang's keynote address at last night's CES conference in Las Vegas. He mentioned some names, and he mentioned a partnership with Uber for autonomous driving. So that is in line with some of NVIDIA's autonomous efforts. Our data on your systems is basically what he talked about, a strategic partnership for AI technology for autonomous cars. That will help Uber stay competitive in autonomous driving. NVIDIA platforms, Cosmos and DGX Cloud, they will accelerate the development of autonomous driving solutions. So good for Uber to use NVIDIA products, and let's face it, anytime you are partnered with NVIDIA, it's a pretty positive statement. So they're using the Cosmos, they're using the DGX Cloud. Cosmos is known for robotics and autonomous driving. It should help Uber compete with Google Alphabet and Waymo, with Tesla and full self-driving. This is Uber competing with them for autonomous driving and partnering with Nvidia. So Uber stock today, it was higher this morning. It's traded as high as 68.84. Now it's basically unchanged on the day. As I said, the whole market has sold off. And by the way, that's a great talking point. Remember, whatever we do on these shows, the whole market, when we talk about high-profile names like we talk about, they're always susceptible to a market sell-off that as you're seeing today. So the trade we did, with the paper money trade we looked at in Uber, is something in the call diagonal family. Going out till January 31st, buying the 67 call, which is, just about 70 cents higher than where the stock's trading right now. It was trading there when we put this trade in. And then selling this week's January 70 call. We put that in about 275 debit. It's trading about 2.25 now. Stock is, like I said, come back down to unchanged on the day. But this is a way to get bullish on Uber without buying the stock, without committing to that large capital outlay of buying the stock. The debit on this, 275 on the screen, trading about 230 right now. That's the risk. The debit paid is the risk on this trade. Buying the 67 call. Now, this is the strategy that we're talking about. Can you adjust these strikes based on where the stock is sold off? Of course you can. Could you do the 66, 69 trade? Yes. But the shape of that curve will remain the same, with the peak of that curve being what? The short strike, the one we always talk about. That's where you always want the underlying to go, is to that short strike, because here's the theory. That's the highest that the 67 call can trade, while the 70 call trades zero on expiration day at 3 o'clock. So that's why that peaks right there, and that's why that blue line is expiration day. It peaks there. So remember, you're collecting theta. You are risk defined to the debit paid. Remember, you do have, because this is a 3-week spread, about 21 days between, you will have opportunities to extend duration on this trade and chip away at that net debit. And when you do that, you also chip away at the break even on this trade. So there's two ways to look at upside moves. One with all the options in the same expiration, which is the unbalanced butterfly. And number two, something in the calendar spread family. In this case, it's the diagonal. It's a calendar spread with an embedded 67.70 call vertical, thus creating the diagonal spread. All right, those are our two trades for today. Thank you for joining us with Daily Trader. I'm Kevin Hincks. Have a great day, everybody.